Hello again. It is time to discuss chapters 7 and 8 of the textbook and basically reach the halfway point of the term. Hooray for that. The chapters, particularly chapter 7, is mostly conceptual. Much of chapter 8 is also conceptual, but I'll have a few words for you, a few suggestions about how to interpret one of the only, and maybe one of the more complex quantitative issues that you'll find in chapter 8. And away we go. For chapter 7, I'd like to basically point out a couple of the figures to you, which are pretty important figures in the field of business and the specialty of accounting. First, there is figure 7.6. And it looks simple enough. Information comes from some source, the source document. It's initially going to walk through a series of processes, and then it will wind up being issued in your final financial reports or your financial statements. The data is going in and out of data storage as you go along, but basically, the way that you create a financial report is to take numbers out of a source document. Those would be your inputs. To put them through a series of calculations, those would be the processing activities, and then be prepared to issue them in some kind of report function or format, and that would be your output. And as a general comment, you will be finding that you will deal with inputs, processes, and outputs, or to put it in a different way, raw data, calculations, and then formal reports throughout your time in 2301, throughout your time in 2303, that is the next accounting class, and actually in every business class that you take. You are taking information, inputs. You are processing it in some way, or evaluating or analyzing it, processes, and then preparing some type of report or presentation output. That's figure 7.6. The other concept that I thought was worthy of note in this chapter is figure 7.8, which describes certain types of specialty journals. Now, why do you need such journals? In reality, you don't, but they make life easier for you under certain circumstances. What kind of circumstances would require you to create a journal? Well, let's put it this way. Let's think of this example. Let's assume that there is a snowstorm, and you grab your shovel, and you work your way up the block. And every 15 minutes, you walk up to the next front door. And you pound on the door. And someone answers, and you say, "There's been a snowstorm. There's a lot of snow on your driveway. Would you like me to take the next 30 minutes shoveling it out for you, clearing the driveway? If you do, I'll spend the next 30 minutes working for you, and then at the end of that time, you will give me $20. Well, let's assume that there are 5 houses on a block, and you go to each one of them. And over the course of 2.5 hours, you shovel out 5 driveways, and you get $20 per driveway. 2.5 hours after you start, you will have $100 in your pocket. Now here's the question. When you update your accounting records, do you increase cash and increase revenue, which is value 5 times $20 each time? Or do you basically simply group the 5 20s together and say, I just spent 2.5 hours shoveling this block. I'm going to increase cash by $100 and increase revenue by $100. Well, one way or the other, you probably do want to keep track of the fact that your $100 of cash and revenue came from 5 different customers, $20 each. If you do it by listing 5 different $20 transactions in your general ledger, then there's no need for a specialty ledger, a detail ledger, if you will. On the other hand, if you say, in my primary accounting record, my general ledger, I'm just going to write cash increased by 100, value or revenue increased by 100. But I'm going to keep a side ledger, a detail list of the 5 customers who paid me $20 each. Then that side ledger, that detailed list, would be a sales journal. And if all 5 give you $20 each, then the sales journal would look a lot like the cash receipts journal. However, if 5 customers tell you, I'll pay you $20, but if only 4 customers wind up paying you $20, and the 5th customer says, oh my gosh, I don't have cash on me, I will pay you tomorrow, then the sales journal will say, revenue went up by $100. But the cash receipts journal will only add up to 80, because you will also have a $20 asset called accounts receivable for the customer that will pay you tomorrow. And that concludes our discussion of Chapter 7. It's quick, it's to the point, it's high-level conceptual information. I hope you found it helpful. Let me now go on with you and talk about Chapter 8. Much of Chapter 8 is also conceptual, but I do believe that there are 1 or 2 figures that will be helpful to you. First of all, let's go look at figure number 8.2. Figure 8.2 is a fraud triangle. It's really quite simple. It's just a list of 3 different criteria, if you will, that usually are in place when someone commits fraud. Number 1, they need to see or perceive the opportunity to commit fraud, to do something bad and make some money. Number 2, they need to have the incentive to do it. They need to be motivated to steal. The third piece of the pie is perhaps the most interesting one. They need to be able to rationalize that what they're doing is appropriate. More often than not, people who steal, who commit fraud, not only see the opportunity to do so, not only are incentivized to do so, but they comfort themselves or they justify the crime by saying, I deserve it. I've had a hard life and I deserve to steal this money. Or this person or this company treated me poorly, and thus by stealing from them, I am only getting a little back. That type of behavioral rationalization is what you often find happening in the minds of people who commit fraud. And therefore, it is the third element of the fraud triangle. Well, I have to confess, that is a relatively highly conceptual thought. I did promise you, however, that I would walk you through some numbers in Chapter 8. In order to do that, let me take you to Figure 8.6. And just beyond 8.6, that figure is a quantitative example. This is a bank reconciliation. What is it all about? Well, you have a bank account. It is, in this case, a checking account. And every once in a while, you log on to the website to look at how much money the bank says you have in your account. And inevitably, what the bank says you have is not what you thought you had as a bank balance, as a cash balance. And so, in this example, as you see in Figure 8.6, there are a couple of reasons why the bank was wrong. The bank number on the bank's website that tells you how much cash is in the bank, that might actually be wrong. On the other hand, your number, what you think you have in the bank, might be wrong too, for, in this case, 3 or 4 different reasons. And so, if the bank balance, what the bank says you have, is wrong for a couple of reasons, that's the left side of Figure 8.6. And if what you think you have, your book balance in the bank, if that number is wrong for what looks like 4 different reasons, that's on the right side of Figure 8.6. Then the actual accurate number, the amount that you have in the bank, is what 8.6 calls the adjusted bank balance. Now, what goes into the adjusted bank balance? Let's look on the left side. You thought you deposited some money in the bank. You were right about that, but the bank has not yet gotten around to posting it yet. If you thought the money is in the bank, and it is, but the bank simply has not posted it yet, then what the bank is showing is wrong, because it does not include those deposits that are not yet posted, which Figure 8.6 calls deposits in transit. Similarly, you might have written a check, but the bank may not have posted that check yet, and therefore the bank has not yet reduced your balance by the check that you wrote. You know that you wrote the check, it simply hasn't cleared yet. The bank is not yet aware of it, they have not yet posted it, but they should. And as a result, you would want to correct the bank's balance by reducing it by the amount of checks that you wrote. Those are what we call outstanding checks. And so deposits in transit and outstanding checks are increases to the bank balance and decreases that you know are correct, but the bank simply has not posted them yet. You correct the bank's number, the balance, by adding those deposits in transit and subtracting outstanding checks. Now, by the way, The corrections on the right-hand side of figure 8.6, those you should think of as just miscellaneous corrections. You goofed. You earned some income, it got into the bank, you never recorded it. You earned interest, you forgot to record it on your side, on your checkbook, in your books and records. You spent some money, those are expenses, you just forgot to record them. And the bank sent you an email message that said, we're going to charge your account for doing something for you, and once again you simply never got around to recording it on your books. These are just a miscellaneous array of different increases and decreases to the cash in the bank. You were just not getting around to recording it, and so you should record it now. The bottom line is, what figure 8.6 tells you is, if you look at what the bank says you have in terms of cash, and it's not what you think you have, first, look for reasons why the bank simply failed to post something. Let the bank know that they failed to post it and adjust the bank balance accordingly. As for you, look for your own errors that you made. Maybe you recorded something incorrectly. In the case of these 4 examples, you just forgot to record increases or decreases in cash. Record them now. Better late than ever. And when you finally adjust or correct the bank's number, the bank statement balance, and your original number, the book balance, you should come down to the adjusted book balance, which in each column should be equal to each other. For an example of this, go immediately below figure 8.6. It looks like there are about 8 different items of information that the book gives you, but then look at the actual bank reconciliation that follows in the textbook. In this example, you think you have $32,760 in the bank. You log on to your bank account and the bank says, no, you have $77,040. Woohoo! Should you go out and spend it? No. Perform this reconciliation. As you can see, the reason why the bank statement balance is so much higher than your balance, well, it's attributed to a number of different reasons. It seems like you made a deposit of $34,300. The bank hasn't recorded it yet. It seems that you've written a couple of checks. The bank hasn't recorded them yet either. And it looks like the bank made a $320 error. That's very unusual for the bank to do that, but I guess it happens. And so after you correct the bank's balance for these errors and inform the bank of these errors, turns out that the new bank balance that shows up on the website of the bank is $92,040. And then you say, wait a minute, I thought I only had $32,760 in the bank originally. I was excited when I heard that I have over $77,000 in the bank, but now you're telling me that I actually have $92,000 in the bank? How the heck did that happen? Well, as you can see by this example, you made 5 different errors. The biggest one? Someone paid you $60,000 and the bank got the money, put it into your cash account. You never recorded it at all. Your error. You earned a little bit of interest that the bank paid you. You failed to record it. Your error. It looks like you wrote a check that bounced and the bank hit you with some charges. It looks like there was an additional service charge of $80. You didn't record any of those charges. And finally, there is a generic recording error. I guess yet another error that you made of $240. Well, it seems like you're making an awful lot of errors, or oversights, if you will. And that's not a good thing. But at least in this situation, by far, the biggest error of all that you made was forgetting to record the fact that someone paid you $60,000. It got into the bank, so the bank knew about it and you didn't. Again, it's not good to make errors, but at least this was an error on the pleasant surprise side. The bottom line is, before you begin the reconciliation process, you thought you had about $32,000 in the bank. The bank claimed, according to the website where you're checking your balance, that you actually had $77,000. By the time you look at and account for the deposits and checks that the bank failed to post and the miscellaneous collection of errors that you made, that you failed to record, it turns out that you actually have over $92,000 in the bank, which is the adjusted bank balance on both the left-hand side and the right-hand side of this example. Well, I hope you've enjoyed this quantitative example. Congratulations, you've made it to the halfway point of the term. And with the next video in the next module, I will be delighted to take you into the second half of the term.